EasyJet now looks like Takeover arithmetic. Apollo's possible offer is £7.15 a share, above Castle Lake's £6.90 proposal, and both bidders must decide by 5 p.m. on Friday, 7 August, whether to make a firm offer. At 642.23, the market is still leaving roughly 11% between the shares and Apollo's proposed price. That is the tempting interpretation. The stock has been re-rated by competing bidders, and shareholders may receive a cash premium. But the latest operating evidence makes the story less comfortable. EasyJet's profit for the 3 months to 30 June fell 70%, from £285 million to £85 million, as fuel costs rose and passenger demand stayed flat. Before the bidding intensified, one recent analyst-led reading described EasyJet as a compelling buy because its valuation had fallen towards historic stress levels. Citing Citi, it suggested substantial upside if the company returned towards its long-run valuation, while still allowing for further downside. That was a valuation recovery argument. The new fact is that the earnings damage is not merely an old fear reflected in the price, it has appeared directly in the latest quarter.
The mechanism matters. An airline pays for fuel before it can earn revenue from the flight. If fuel rises while demand is flat, passing the full increase into fares becomes harder without weakening bookings. EasyJet says late bookings are strong, which offers some hope that demand is arriving later rather than disappearing. But the available reporting does not show how much of the fuel increase has been recovered through fares, or whether those late bookings carry margins strong enough to repair profits. There is useful counter-evidence. EasyJet has already released almost 14 million seats and 78,000 flights for summer 2027 across more than 135 destinations, with holidays available on deposits as low as £60. That points to continuing capacity and customer interest, not a business in retreat. Yet a large schedule proves opportunity, not profitability. The unresolved question is whether those seats can be filled at prices that cover a more expensive operating base. Nor should the latest Gatwick fuel warning be treated as the whole investment case. The airport said a technical problem could disrupt supplies for 2 days, but airlines were still operating normally, and short-haul carriers such as EasyJet were expected to be less affected because they could take on extra fuel elsewhere. That looks like a short operational shock, whereas the profit decline and wider fuel pressure are the more important cycle.
For a holder, the bid creates a defined near-term decision point, but not a guaranteed floor. EasyJet has said there is no certainty that either approach will become a firm offer. For a watcher, the mistake would be to treat the bid as proof that the underlying earnings problem has been solved. If a firm offer arrives, the immediate valuation question may be settled in cash. If both bidders walk away, the shares will again have to justify themselves through bookings, fares, fuel costs, and cash generation. So today's evidence supports an event-driven opportunity, layered on top of a cyclical airline recovery, not a confirmed structural transformation. The decisive observation is Friday's firm offer deadline. Beyond that, the material uncertainty is whether strong late bookings become durable, profitable demand, rather than merely fuller aircraft at inadequate prices.